So here we are in session number 2 of the Millionaire Real Estate Investor Book Club. Everybody, we've been reading this book by Gary Keller, the Millionaire Real Estate Investor, and we have had such a great time just kind of getting the basics of the mindset and all the functionality of how we need to think in order to get set up to be millionaire real estate investors. And I'm going to back up a little bit and remind us where we're starting from. So, hang on. Let me hit present here. So in this model of the millionaire real estate investor, we talked last time about understanding your criteria and really the buy box of real estate for investment. And then obviously the terms of how to put the deal together and not overthinking the power of the network and the people that we're in relationship with and how they help us move in this direction. But today we're really going to talk about the first part of this triangle, which is the thinking. And then we'll move into obviously buying and owning and ultimately receiving a million from the investor perspective of the millionaire real estate investor. But today we are going to dive into thinking. And today is really about the I keep pushing the wrong button here. Today is really about the mindset of a millionaire real estate agent. And I'm starting on page 75 in the book. And I would like to just remind everybody, this is a book club. So we're really kind of diving into the book, going after the cliff notes, if you will, the concepts in this book, and not so much a class as much as it is a book club. So on page 75, one of the things Gary talks about right out at the gates, he says, it's my belief that the pursuit of money is actually a spiritual journey. And that word spiritual means a lot of different things to a lot of people. I would insert, it's our relationship with money that determines our pursuit of money, and that makes sense. And how we have a relationship and how we spend and how we save and how we were brought up to think about money, mentors in our lives that taught us about money. And this concept of being a millionaire real estate investor has everything to do with how we think about money. And he goes on to say, no matter what your personal faith is, spirituality and money are always connected. And he says, money, what you do to acquire it, how you hold on to it, and what you do with it reflects your innermost values. And I'm not sure we all like that statement. However, if we all kind of opened up our checkbooks or our bank statements these days or our debit card statement, you could certainly look at where you spend your money on and understand that speaks to how where you put your values in your life and your innermost values. So it's kind of it's a tough reality when it says, and whether money reveals you to be an honest or dishonest, generous or greedy, it's you, it's not the money who inherently owns those values. So whether we're greedy or generous or honest or dishonest around our money, ultimately it's our values that's coming to the table. And the reason he starts with all this is I think this is a reality check for all of us, is if we truly have a desire to grow wealth, we truly have to understand our thinking and our relationship with money. And at the bottom of page 76, he highlights, money is good for the good it can do. And I don't want to go too far down this rabbit hole on this book club, but I would tell you, if you struggle with the concept of money, it's worth exploring, because a lot of people have different emotional reactions about being wealthy or not being wealthy, or their spirituality relationship with money. There's certainly spiritual advisors you can engage to explore that relationship. But ultimately, there's a universal truth that says money is good for the good it can do. And if I have money, I can go make a difference in the world. And if I don't have money, I'm limited to the resources that I have in the difference that I can make. And time is certainly a resource, but money becomes a leverage in and above our time, which is certainly a limited resource. And then he talks about the simple truth is that you don't grow personally with the growth of your fortunes, you're unlikely to grow them very long. So, meaning this process of whether you're learning to become a millionaire real estate investor or learning a new skill set, if you don't grow as an individual along the journey, whatever you acquire along the way is certainly not going to last long for you. You do have to grow, and that requires changing our thinking along the way. And I highlighted this at the very end of page 77. And I said, this is the goal, right? We're all looking to become millionaire real estate investors. But here's the goal. It says, if we can tap into the mindset of people that are millionaire real estate investors and grasp the fundamental principles of how to build, hold, and employ wealth, you'll have achieved the first major goal of this book, which is the thinking like a millionaire real estate investor. So that's why today's class is centered around the thought process and our thinking. And you could insert mindset, but I like the concept thinking. So moving on, there's 7 basic ways a millionaire real estate investor thinks. And it sounds simple, yet some of these concepts are very rich and deep in where they go. And obviously, the first one is think powered by a big why. In this conversation, we've talked about for years, whether you're pursuing real estate success or you're pursuing success in life. And it certainly plays a role in understanding how millionaire real estate investors think and why it powers us and it brings us energy to move towards well, hang on. Did y'all lose the screen share? Somebody called me. How dare they? There we go. Can you see it now? All right. So being thinking by power to big why is a really powerful concept that a lot of people are challenged and grasp, just grasping what's my why, right? Well, in context of investing, there's a book called Think and Grow Rich that Napoleon Hill, he wrote, what a different story men or women would have to tell if they only would adopt a definite purpose and stand by that purpose until it had time to become an all-consuming obsession. I don't know if I like the word obsession, but if you've ever had a goal or a desire for your life that was so strong, maybe obsession's the right word to describe it. But really, that's kind of what a big why kind of feels like and talks about. Um, Gary talks about the primary characteristic I found in the lives of high achievers is that they have a strong drive to succeed. They had a compelling personal reason to achieve, and that's what we call a big why. So it's really important to just kind of understand the concept of a big why is that it's that thing inside of us, that emotional thing that is so compelling that it pulls us to success. So in the context of sales or other aspects of our life, it's what's pulling us to do the things that we know we need to do, but maybe don't want to do on a day-to-day basis. An easy example of this is everybody sometimes in their life finds themselves on a weight loss journey and they have a desire to lose weight, but if a doctor tells you if you don't lose weight, there's going to be a severe health consequence, the emotion changes around that pursuit and pulls you a stronger way towards towards that goal, if that makes sense. So in this context, what is our why? Why do we want to invest in real estate? Why do we want to build wealth? Why do we want to move towards financial freedom? The millionaire real estate investors we spoke to while researching this book shared with us the fact that their motivation arose from a desire to be free from their jobs, to have more choices in their life, achieve self-actualization, and gain the security that comes with abundance. And that kind of speaks to what that obsession was, that I wanted a better life for myself. I didn't want to be paycheck to paycheck. I didn't want to be, I didn't want my life defined by, I had to be uh, working this job. I wanted to have a more choices in my life. And so then it says, ask yourself some of the questions like, how much am I capable of? And what's possible for me? And those are big questions. And I'm not sure the first time you ask yourself that question, it's even answerable, if that makes sense. If I just said, what's your potential? Um, Most people would just stop for a second and go, well, I know I'm capable of a lot, but I don't know what the destination to that is, right? And in some cases, that's where this concept of a lot of little whys uh, kind of helps us tailor back to the big why. So in the book, they have this analogy like all these little whys, and hopefully, as you're discovering your little whys, there's a common theme. So, for instance, little wise could be working hard to pay off college loans, could be eliminating credit card debt. Maybe you want a new car. But as those big things, as big as those things seem right now, they're really short term focuses, right? And that credit card may not be your why 10 years from now, or that new car that you wanted today will be tomorrow's trade in, right? And, but the truth is, we're looking for that theme that helps you kind of pull up to that big, compelling, emotional thing that causes you to want to go move in this direction. You know, Gary talks about a couple examples would be, I want to be as financially wealthy as I can be. I want the largest life possible for me. Big whys related to achieving your highest potential are, in my experience, the most powerful. And he admits there's usually no cap to it, right? So having no motivation will lead you nowhere. And we see this in all aspects of life. People that are unmotivated are just kind of in the position that they're at, and people that are really motivated are out there making a difference, right? And this certainly plays a relationship into investment. um, it requires a big why, right? A ever growing big why. I want the largest life possible. And possibly the most tangible gift of a big why, once we discover it, is that it requires and enables you to prioritize your needs as well as the choices and actions that you will fulfill them with. So ultimately, not only does this why become this emotional, compelling pull to get us to do some things that sometimes we don't want to do, but it also becomes a little bit of a filter in how we make choices and decisions. And that's why understanding your why is such an important part of everything we do. And we talk about it in real estate success, and it certainly matters in wealth building success as well. That's why it's one of the first things of why a millionaire real estate investor and how they think. And then the second way they think is they think in big goals, big models, and big habits. And what does that look like? Well, I want you to understand the formula behind this. So, big why. I want to live as big of a life possible. I want to have financial freedom at some point in my life where I get to wake up one day and choose what I do. Well, in order to do that, I have to quantify it. Meaning, is there a dollar amount I need to have in the bank? Is there an income stream I need to create? Is there a certain number of houses I need to own? Is there a certain number of investment blank that I need to own? Because those goals ultimately are the specific measurable targets that will ultimately fulfill your big why. So think of it this way. The big why is that emotional feeling, that emotional desire, that emotional pull. And then we've got to put some numbers to it. And that's where the big goals come in. So goal setting is a always been an interesting experience for a lot of people because um, some people take the goals and it actually becomes a negative experience where it's the stick they're beating themselves up with when they don't hit it. But other people understand that big goals is just a point on a map that causes you to build a plan and do different things as you move towards that goal. So remember this formula: big why, emotional desire of where we want to go, and then we're going to quantify that with our big goals. And then we have to put models to it. And ultimately, those models cause us to have habits in how we go about in our lives. So let's break that down a little bit. So if you want to live a big life, your thinking has to lead the way. And this is still centered around how a big life and a big thinker all intersect. So obviously you'll hear this throughout the journey of life is, I wish I had sooner. If I had known now what I knew then, I wish I had sooner. And what's powerful in that phrase for us to understand is people have walked the earth before us and they have made mistakes and they've discovered the faster paths to get where we want to go. And we should learn that, right? So I believe in thinking big, but I also know that's not enough. Without big models, big goals, big habits, big thinking may just be wishful thinking. And by itself, wishful thinking isn't that useful. There's only a small difference between living a great life in your head and living a great life in reality. But that small difference makes all the difference. It has everything to do with actions. So that being said, if you don't know where you're going, any path will get you there. Interestingly, the opposite is equally true. If you know where you're going, there is a best path to getting you there. And that's where the models comes in and how the relationship with the big goals. So I'm gonna keep going back to this formula. Big why is why we want this. What's the emotion? I quantify it with the big goals. And then I should look around at people that have done it before me, whether it's attending a class like this, reading a book, going to a seminar, finding a mentor, hiring a coach. Those aspects of our life should be bringing models and how to go where we're wanting to go, and those proven systems and strategies for reaching the goals. So really, that's what this book is. It's all the models of how to become a great real estate investor. And we're going to dive into all that and teach you all the models. And you got to make sure you have the thinking part first, which is what we're covering today. And once you understand the models, let me put this graph up on the screen real quick. Um, the habits is the second part of this, and boom, boom, boom. Here we go. So if you can see this graph on it's figure 3 on page 84, and it talks about our net worth. And over time, um, we might have a net worth model to build a $5,000 net worth. And what are the habits we would have to create to grow our net worth that way. I could probably save $50 a month, and that would be a habit that would move me to that net worth. And if I had a goal of $1 million net worth, what are the habits that would require me to adopt that would move me in that direction? And I can start today with the habits. Um, and then ultimately, I just need to understand the relationship between the habits and how I show up in life to the model of where I'm trying to go. Here's the negative part of this: there's bad habits. I know people that have shopping addictions, and I know people that have uh, they call it burn the money. My dad used to say when I was growing up, "Don't let that money burn a hole in your pocket." Like the minute I got money, I had to go find something to spend it on, right? As a kid, and those are bad habits, right? And those bad habits ultimately translate to negative net worth, right? And so it works both directions. In what are the habits we're adopting, and are they in alignment with our goal and our model of where we're trying to go? Does that make sense? Perfect. All right. So back to the content of the book here is big goals is the quantified big why. Where do we need to go? Where do we want to go? Big models is finding the proven systems and strategies, how to go after where we're trying to go. And habits are what are the actions and the choices I make on a day-to-day basis that I learn what habits are necessary by the models I'm pursuing. Everybody on board? Makes sense? All right. So then this whole concept of thinking takes a weird turn on us all here. And before we get there, I want to point out a couple things. On page 85 in the middle, Gary talks about a survey that was done in 2001 by the Consumer Finances of the Federal Reserve. And it documented that people who rent property for a living have a net worth of less than $5,000, while the typical homeowner has a net worth of less than $175,000. So just the simple fact of somebody owning a home drastically changed their balance sheet around net worth. And I think this is an important concept for us to understand because we all choose real estate as our profession, right? So the simple concept of net worth is going to come up a couple times in our conversation today, but he first mentioned it on page 85. And then on page 86, speaking to habits, he said, just simply, good habits put money in your pocket and bad habits take money out of your pocket. And just like the phrase, don't let that money burn a hole in your pocket. That's the bad habit of money coming out of your pocket, right? Um, Page 87, think money matters. So this is where this money matrix comes in. But before we jump into the money matrix, there's a fundamental thing I think everybody has to understand around wealth building. And this fundamental thing he speaks to around think money matters. He said, we all have a fundamental choice in our lives, in our financial lives. The path of earned income or the path of unearned income. In other words, you can work for money or money can work for you. And it sounds so easy to be read or written in a textbook because we all understand that there's a necessity to wants and needs that money requires, but it's not the reality of that statement. It's the thinking behind that statement. And it's some people understand how they define their life being, I work for money and I have a relationship with money based on I go to work to earn that income. And other people have a relationship with money where they say, I know I earn income, but I need to figure out how to use that income to work for me so I don't have to work for money for the rest of my life. And there's a fundamental difference, and we're going to spell that out for you here in a minute. And same thing, it says you get paid only for what you do, or the other is you get paid no matter what you do. So when you're an investor, you created a cash flow that comes to you. When you're an employee, you trade your time for money. And it's the difference in how people that understand wealth and investing think about money. So it's really kind of how do we set ourselves out on getting this MBA or this master's degree of money. And the goal of this book is to get you on the positive, life-changing path to passive income as quickly as possible. In order to do that, we speak to you in how you think about money. And this is what we call the money matrix. And the money matrix has the same 4 words on the top as it has on the bottom. And let me define the 4 words for you. So capital is defined as money investing in anything expected to grow in value. So if I put money into something and I expect the value to increase over time, cash flow is money that's generated from those investments. Cash is money held in reserve for security or future investments. And consumption is money spent on anything not expected to grow in value. So that definition of consumption is really important. And these are defined on page 89. Consumption is money spent on anything not expected to grow in value. So let's look at this money matrix for a minute. And the white line in the middle. So shadow wealth is built on consumption and cash, and financial wealth is built on capital and cash flow. So if you receive $20,000 today and it deposited into your bank account, you realize there's certain people that have a relationship with money and they start asking themselves, what can I go buy with that money? Could I go buy the car I've been wanting, or could I go buy that watch, or could I their brain and their thinking goes to consumption first, and that consumption takes the chunk of money first, and then whatever's left over, they start to hold on to cash in that relationship. And ultimately, if there's an excess of cash, cash flow is the next thing they think about. And then if there's abundance in cash flow, capital, it becomes the final piece to that equation, right? Where the financial wealth is built on the opposite of that. If you receive the $20,000 today, capital, money investing in anything expected to grow in value. If you first think, what could I put this into to grow in value? You're moving towards a financial wealth thinking versus a consumption thinking. Does that make sense? So instead of buying that watch, what investment vehicle would you put it into? Listen, it's not a fun conversation sometimes, but it can be fun if you're playing this game and it's it's the game of life and you're trying to build wealth. And then ultimately, when you put money into investment vehicles, it should start to generate a cash flow for you. And that cash flow starts to accumulate cash. And ultimately, you can consume and not feel guilty about it because of the excess of cash, or it becomes the afterthought, not the first thought. And really, this is what the money matrix helps us understand. On page 90, it says, as a result, while investors are generating money from their investments, Consumers are at best saving money for security. Later, while investors are setting aside more money for future investments, consumers are trying to wring some return out of their modest savings. Finally, while investors are free to spend all that's left, consumers are struggling to invest the little that is left. And this is a fundamental paradigm of an exponential factor of financial wealth thinking gets you there faster. Consumption thinking is the slow road, right? It's the road that takes forever. And then there's this concept of shadow wealth. And I'm going to describe it the way I see it. And you can read in the book on page 91 on how Gary describes it. But when I teach wealth building, I like to explain the difference between active income and passive income. So, for instance, I might know somebody that has a high income salary, and that high income salary affords them the ability to live in a big house, and it affords them the ability to drive a cool, fancy car and fancy clothes. And to society's definition, I might even label them rich, but that may not mean they're wealthy. And there's a difference. So if you understand this money matrix, in that analogy, somebody with shadow wealth spent all their money on a house, spent all their money on a fancy car, spent all their money on uh, what made them happy from a consumption standpoint. But to the rest of the world, we all think they're rich. But if you pulled the sheets back or the curtain back or however you want to call it, there's not a lot of wealth behind that. Where um, somebody that has a financial wealth mentality understands consumption's the fourth part of the equation, not the first part of the equation. And it's a way of thinking. And you'll hear stories in your journey of life of school teacher that uh, left millions to people on a school teacher salary of $40,000 a year or whatever. It's because they understood this concept and how to go about building wealth and the exponential factor to that. So also, let me show you a couple graphs here. On page 91 is this, here we go. So on page 91, it's the path to passive income. And it's just crooked today, isn't it? So in the beginning, you work for money and 100% of your income you make goes to consumption. And we understand that you're paying bills and your lifestyle. And of course, there's a conversation around lifestyle that we all probably should have. But the purpose of this is what activity and into capital and building wealth can you do to find a way to create 25% of your consumption where it was passive, not active. And then over time, that grows. You're investing earned income to get unearned income. So over time, it's a stair step, right? And let's say somebody makes $100,000 a year in this analogy. What would they have to do from a income or unearned income perspective to replace 25,000 of that 100,000 annually? And then after they take that 25,000, how do they move that to 50 and then 75,000? Ultimately, $100,000 is coming from unearned income through investing. The next chart I would show you is it shows the path of money of a financial wealthy person versus a consumption person. So a financial wealthy person takes the income in, and that income comes in to cash, but they take some of their cash and let it go through to consumption, but they also take some of their cash and put it into capital. And that capital works for them to create cash flow, which creates a wealth matrix and helps them grow their financial wealth. Where the opposite of this is a financially poor money matrix is they're taking the income in to cash and it's all going to consumption. So there is no capital or cash flow being created. All the money's flowing through to consumption. And sounds simple, simple drawing, but at the end of the day, this is where big habits come in. And this is where our habits and what we do with our money plays a factor in our ultimately our financial wealth determination and how we get there. So really this money matrix is such a simple yet profound concept that moves us towards our goals. So once we kind of understand how we have this relationship with money, and I actually wrote down on page 94, the first time I heard this principle around the money matrix was in the book Rich Dad Poor Dad that a guy named Robert Kiyosaki wrote. And he said, listen, the way I learned money was if I decided I wanted to get a car that cost me $300 a month in a car payment. A consumption mentality would mean I'd go buy the car and I'd make sure I could budget $300 a month for the car payment. But a money matrix or a financial wealth mentality would say, what do I need to invest in that would create an income stream of $300 a month? So then I can go buy the car. So how do I go create an income stream to finance the luxury of my life? And ultimately, financially wealthy people know that luxuries of like cars and houses and clothes and all that stuff is a luxury of life, but they know how to finance or how to create income to pay for luxury instead of using consumption to pay for luxury. So net worth is really where the scoreboard comes into play. And on page 94, Gary talks about if you want to win big and you want to win, you have to know how to keep score. And that's where net worth comes in. And net worth is nothing more than a simple calculation of what you own minus what you owe. And the value difference is ultimately your net worth. And he says, in fact, like most people, I probably place too much importance on my earned income when I should have been tracking my assets, capital, and my unearned income, cash flow. And think about this in our world. We spend a good part of our life fighting the game of how much money we can make. And, I joke with team leaders all the time because every new agent that walks in the door, not every, but almost every, the first thing they say is, I want to make $100,000 a year. And it's been that same number for I don't know how long, but it means they're chasing that earned income, right? They're chasing that earned income, which I don't think is a bad thing at all. I want to be clear about that. However, if they chased a net worth with the same passion that they chased an earned income, that's the thinking behind financial wealth. So a lot of people chase an earned income and then get caught in the consumption game based on that earned income, and their lifestyle does like this with their earned income as it goes up over time, instead of their financial wealth going like this with their earned income over time, because they understood how to think about money. And it's a really, really important concept to get. Uh, Gary talks about what I discovered was that even in my own home, which I had originally treated like an investment, was in fact an appreciating asset. And we're going to dive into real estate specifically here in just a second around why real estate is such a powerful tool to building wealth and being a millionaire real estate investor. But in context of net worth, most people don't think about the home they live in as something that creates net worth for themselves. But just owning real estate is such an important part of growing net worth. That speaks back to what I told you earlier, is the average net worth of somebody that rents a home is less than $5,000, and somebody that just happens to own a house, automatically their net worth goes up by like $150,000 on the median numbers, right? So owning real estate is so powerful. That's why they call it the able investment. And there's like 7 terms we're going to dive into on why real estate is such a important investment. But I want to show you just kind of the graph that explains what I'm talking about. Keep bouncing back and forth here. Here you go. So the impact of real estate ownership on net worth. So in 1992, the median net worth of a homeowner was $122,300, where the median net worth of somebody that rented was only $4,000. It's a $118,000 difference. And the last time they did this survey was in 2001. And the difference of just somebody owning a home, their net worth difference was almost $167,000. So it's such a important thing to be not only knowing these numbers and applying these numbers to our life, but also I think we have a responsibility in the real estate industry to teach people this concept, because owning a home, whether you're 25 years old or 60 years old, matters all the more to your net worth, which improves the financial position of your life. All right, let me get back to our presentation here. So back to why real estate is such a able investment. A couple concepts is it's accessible. Anyone can buy it. So what does that mean? Well, can anyone buy it? A couple of years ago, anyone that could fog a mirror could buy real estate. And certainly you have to have a job and income and credit, and we kind of understand all that. But the truth is it's available to everyone. So as long as you can build your life around being a responsible person with money, you have accessibility to buy real estate, and you have accessibility to invest in real estate. And what does that really, really mean? It just means that there's typically no insurmountable financial barrier to entry. Even the government wants you to own real estate. That's why there's government programs. There's FHA, minimum down, VA, 100%, first time home buying credit, tax things. And we're going to talk about that in a minute. But at the end of the day, it's important for a capitalistic society for real estate to be accessible and that anybody can buy it that proves himself worthy and responsible. And it's really just such a important thing, because third world countries, this is the difference between us and some of the third world countries, right? They're not all countries have an economy where people can buy real estate. And real estate alone is such a difference between wealth accumulation, as I showed you in that previous graph. And that's why society is it's so important that real estate is an accessible thing. And whether you're building your investment portfolio or just teaching this to anybody and everybody, I would want to make sure you understood that concept. Second thing is real estate is appreciable, and it increases in value over time. So there's a lot of people that would try to argue that. But here's kind of the things you need to understand. One is general inflation drives up the replacement cost of housing. So if you're not familiar right now, the cost of lumber to build a house is like astronomically more expensive than it was a year or 2 years ago. So just that simple fact that inflation is causing building materials to go up is causing the price of real estate to appreciate. So if we as homeowners or investors own real estate, we benefit from that appreciation over time. And just naturally, inflation in the U.S. economy has been a natural, healthy rate for a very, very long time. And owning real estate over the course of my life has always been an appreciable asset. Secondly, there's influence of supply and demand. So in the US, the population is continually growing, which is continually putting pressure on the demand for housing, and the supply of housing has been in a limited basis for, I mean, a long, long time. And ultimately, that causes home prices to appreciate. If you're in the real estate industry right now, I don't need to tell you that. The prices are going up and up and up. So the more real estate we own, whether it's the house we live in, or we own 10 rental properties or 100 rental properties, the fact that real estate alone appreciates causes our financial freedom to appreciate, our net worth to appreciate towards our financial freedom. And it's such a important concept to know, because today, if I buy real estate, the average rate of appreciation in the U.S. Is about 6.1% a year. It looks like that was done from 1972 to 2002 is where they averaged that when this book was written, where inflation on average is about 33% a year. If we look at figure 12, and I'm going to pull that up here in just a second. So let's look at these two figures and help kind of understand what appreciable really means to us around owning real estate. So the first figure is it's the growth in the population of the U.S. And the population, if you can see, has continually grown at a healthy growth rate over from 1972 to 2002. We are not shrinking as a population. And the percentage of homeowners is this line in the middle. And you can see it's gotten tighter and tighter around the number of people that own real estate. And that's a healthy figure for us to understand when real estate is an appreciable asset, because the demand for real estate, it continues to go up. And when you understand inflation, uh, inflation's the line graph here, and the average home price is the bar chart, right? So inflation continues to go up as well, which inflation speaks to the cost of material, the cost of rebuild and or building a new home. And that alone causes the price of real estate to appreciate, which is a important factor to understand when building wealth. All right. And the next one's leverageable. And I think this one's such a cool concept because, well, let me explain it to you, and then I think you'll agree with me. So real estate's leverageable. Even though the 6.1% appreciation rate mentioned earlier may not seem like a lot, but that figure is actually, uh, it's a little deceiving. It doesn't take into account the fact that practically no one pays all cash for a home or a real estate investment. In reality, everyone finances most, if not all, of the price through a mortgage. So understand this concept. As a result, people get the benefit of the appreciation on the full value of the property while having to invest only a relatively small portion of the purchase price. So if I buy a house for $100,000 and I put $10,000 down, I had to put $10,000 into that uh, into that property. But if the property over the course of a year appreciates 6% or 10%, which would be $6,000 or $10,000, as the owner, I get the benefit of that increased equity because it was leveraged. Even though I didn't pay all $100,000, $90,000 of that is on margin on a loan. So ultimately, it creates an exponential return on investment. The example they give in the book, they said, for example, a person may have put down only $30,000 on a $150,000 house. And if that leveraged property is appreciated 6% to $159,150, that $9,150 gain should be weighed against the $30,000 investment, not the $150,000 price. So that gain of $9,150 on $30,000 translates to a 30.5% rate of return on the investment, because they didn't pay cash for the whole property. They paid a percentage down. And ultimately, if you're looking for rate of return on money, we've talked, and Gary's talked about this forever, is, a typical savings account pays you next to nothing in interest, where you might go into the stock market, and if you can get double digit returns, you're doing well, right? Well, think about a 30% return on your money if you were to buy a rent house for $150,000 and put $30,000 down. That's a huge rate of return, and that's where wealth is created. And ultimately, that's why real estate, because you can leverage it against the banks, allows you to build wealth fast and accumulate wealth exponentially fast. And it's one of the very few investment vehicles you can do that with. You can't take a loan against a stock purchase. You can take loans against businesses, but real estate is a safer loan to most banks, so they're happy to lend because it's secured by a property. The next concept is it's rentable. And the reality of renting an investment is somebody else is paying down your debt in exchange for living there. And you get to invest, and somebody else pays for it over time. Now, does that come with headaches? Sometimes. Property managers make a career out of removing those headaches for you. But at the end of the day, somebody else is paying for your investment over time and allowing your wealth to accumulate because you took the risk on the front end. And it's powerful to understand that, because ultimately mortgaging a property is the first point of leverage, because you don't have to buy it 100% cash, but having somebody else pay for it is even a higher point of leverage over the course of the property you own. Improvable. So click, what happened there? Improvable. So we can buy real estate, and if we're smart, we'll buy it at a discount and improve it. And really, this is where the concept of sweat equity comes in. And sweat equity is you putting your time and resources into property, causing the value of the property to go up. We talk to sellers about this all the time. If you would update your house, I could sell it for this much more money. If you would replace the carpet, we can get a higher dollar per hour or dollar per foot sales price. Bathrooms and kitchen bring the biggest return on investment, right? Real estate has a sweat equity aspect to it, that if you put money into improving it, it ultimately takes your wealth to a higher level. The next one are the 3 Ds, being deductible, depreciable, and deferrable. I said it before and I'll repeat it. The government wants you to own real estate. And the reason for that is um, they understand that the economy is thrived by people that live in houses. They buy furniture and fixings and they remodel their house, and they it becomes part of that GDP spend, because people that live in houses is what causes the economy to thrive. So much that they give you tax breaks and allow you to deduct things off your income tax, or they allow you to depreciate an appreciable asset. If you understand what I mean when I say that, is they actually give you tax benefits to depreciate your real estate, even though it's an appreciable asset, because price is causing it to go up. And the third D is deferrable, which just means that sometimes you could do things like 1031 exchanges, where you don't have to pay tax on the sale of real estate if you exchange it into a new investment. Or you can take something like an IRA and buy real estate through an IRA where you don't have to pay tax on it until you take the money out of the IRA. So there's all these government programs and ideas that the government has brought to the table because they want you to own real estate, and they make it a benefit to the people that do. The next thing is it's stable. It's slow to rise and slow to fall. Well, what does that mean? It just means that, well, here's the example. From 1975 to 1998, 23 years, only 14% of the country's largest metro areas experienced price declines of 5% or more over a 3-year period. So unless you overpaid walking into the real estate, if you're prepared to live through the cycle, meaning 5 to 10 years, you're probably not going to lose money over the long haul unless you sell. So even if we go into an economic downturn, if you can hold on to the asset, you will always make money. Real estate is always going up. And at some point in time, you will break even or uh, end up creating a equity in your property. And real estate is probably one of the most stable investment vehicles to building your investment portfolio. And it's important to understand that. Um, we talk about the standard deviation of real estate, and here's a good graph that kind of shows this real estate compared to the stock market. So in the stock market, you can kind of see the squiggly line is the stock market going up and the stock market going down. And you can imagine if you had investments in the stock market, the anxiety of when it's down and the thrill of when it's up, right? But if you look at the average home price, remember, here's the 0% line. So not one time did it go below 0% growth, yet it certainly got close to it. But over time, it's always been at a constant 6% price appreciation from 1973 to 2003. So over time, how stable of an investment is owning real estate? There's not another one out there that I'm aware of that creates that stability for somebody in the investment world. And the last one is livable. Um, Shelter, I kind of chuckled when I first read this, but, we live in a house, or we should live in a house, right? And the shelter that we provide for us and our families is livable. We live here. And just the simple fact that we live here shouldn't negate the fact that this is an investment that we live in. And our property we own is appreciating. The debt is being paid down over time, and our net worth is going up over time. So just know that at the most simplest of way, real estate is the most able investment for people to venture into when building their wealth. All right. So think value, opportunity, and deals. Here's what you need to know about this part. Remember, this is the thinking. So a real estate investor has to be experienced to understand value. And the way they become experienced in understanding value is they look at a lot of real estate and they understand what a good buy is. They understand what the consumer wants. They know that a 4-bedroom house with 2 baths and a 2-car garage is very rentable. They know that sometimes houses with garage conversions or 1 bathroom instead of 2 is not the most rentable property to own. And they make all these decisions because they're out in the market and they understand the value of real estate. And to understand value, it's 2 things. They got to know the value of the price, but they also have to know the rentable value. And understanding those 2 things is paramount to being successful in real estate investing because it determines what an opportunity is. And I made mention in the first class around knowing your buy box, and we talk about Zillow has a buy box, and traditional investment companies, they all have a buy box that says if the property is inside these criteria, I buy. Well, you don't know what an opportunity is if you don't know what your buy box is. And you got to be able to identify value, learn the value of real estate in your area, and you got to be able to determine quickly what price will make that property worth pursuing. And ultimately, what turns an opportunity into a deal is that the property meets your criteria and the seller is willing to meet your terms. And you got to be able to walk away and say, it's not any opportunity, it's the right opportunity for me based on what I believe makes this a win for me in investing. And emotion does not need to be in that equation. Deals aren't found, excuse me, deals aren't found, opportunities are found, and then deals are made. And we need to be careful because emotion creates the way we approach real estate investing sometimes. And the more research we do and the more educated we are on knowing value helps us determine what a real opportunity is and allows us to move that into making deals. So I want to get this concept with you guys because I think this is such a powerful concept. It talks about the different kind of uh, the different kind of people that approach real estate investing, and patience is a big deal when it comes to investing, and when it comes to making money. I think most people don't realize that they are too impatient and confused. What they're confused about is what it really means to be an investor. As a result, they may never take action, or if they do, they take the kind of confused action that can lead to financial disasters. Millionaire real estate investors are not confused. They understand that investing requires action, and the right action, and they think action. And there's 4 different kinds of people that we would classify as investor profiles. And the observer is, they may have all the mental qualities of a great investor, but they don't take any action. And without action, they end up witnessing success instead of experiencing it. And there's no risk and there's no return because they just sit there and observe. It's almost like the career student that knows everything but doesn't do anything, or loves the ideas but buys nothing. And next, which is the risky one of all of them, is the spectator. I'm sorry, not spectator, the speculator. I've got a typo on there. It's the speculator. And the speculators aren't afraid to take action. In fact, they love action to a fault. They continue and they confuse risk taking with investing, and their risk tolerance may border on risk numbness as they pursue their dream of a big, fast payday. And speculators, I always remember reading stories of the gold rush out west, and the speculators, and how they would speculate they could go over here and strike it rich in gold, right? Or the person that plays the lottery as a speculator, or somebody that thinks that they know something that nobody else does, or they got the inside track, or over time you'll have people present you with business opportunities, and they speculate this return, and it's a high risk and it could be a high return, but it's certainly not the best path for real estate investing. Where a collector has an emotional connection to it, and they love the ownership of real estate, and they just like to buy something, and not necessarily a bad thing. They just don't have the pursuit of wealth building, which is uh, really what the investor is. And it's a minimum risk, and the investor loves opportunity and buys the right thing. And they do it through the formula we just went through, which is they know value, find opportunity, and make deals. And they just know the value, and they know a bargain when they see it. And they make their money on going into the property. Gary talks about on page 117, he says, investors are a breed apart. Unlike observers, they take action. Unlike speculators, they minimize risk. And unlike collectors, they buy on the basis of investment value. And they know market value, and they go out and find assets priced below that value. They don't count on appreciation to bail them out, and they make their money going in on the purchase. And I like this. It's like a bargain hunter. They find as much joy in the search for a bargain as the transaction itself. And it really, they're educated. They know how to go approach it, and it's a game to them. And but the game is not to be risky. The game is to follow a system and see how many deals they can find that is within the buy box for them. So ultimately, the question is if you want to be wealthy, you need to be willful instead of wishful. And an investor is willful about how they go about it, where an observer might be wishful, and a collector is emotional. They take action, but they just don't go at it at a level to build wealth. They just go at it from a emotional ownership perspective. And a speculator is too emotional because they're trying to strike it rich, and ultimately it's not the best path to go to becoming a millionaire real estate investor. All right, so where do we go from here? Well, we need to buy $1 million, right? And that's the next section of the book. But the 5 models we're going to go through next time are the net worth model, the financial model, the network model, the lead generation model, and the acquisition model. And this is where the models really start to come to play in how we take this pursuit of becoming a millionaire real estate investor. And I'll end with this. If you take anything in life and you just look at it on a grand scale, it's going to look like chaos and all these different people doing different things. And if you put some research to the chaos, that research starts to narrow what you're seeing down into best practices. And we end up with models of how to go from here to here, just like I talked about in the beginning of today. You have that emotional big why, and then we quantify it with goals. And then these are the models that are going to show us how to get there. Thank you for your time today. I hope you learned something. This was part 2 of the Millionaire Real Estate Investor series, and I'll see you next month for part 3.
Thank you.